Good afternoon, everybody. If somebody could just let me know that I am actually streaming out and the universe can hear me, I'd appreciate it. Am I live right now?
Yes, you are.
Okay. I don't see any texts or chats here. There we go. Hi, Wendy. Thank you. I appreciate that. Okay, so welcome to May 18th here, 2020, and this week's weekly Market Huddle. I'm Joe Lucey. Special guest this week, we have Tony Shink, Institutional Director for Minneapolis Portfolio Management Group. Here's how we'll do this here this week. As you know, typically we've been doing a little bit of time here where we spend a little bit of time about what the overall economy and the markets have been doing and such. This time we're going to spend a little bit more time talking about, number one, who Minneapolis Portfolio Management Group is. Number two, where are they now with everything going on? And maybe the next $3 trillion question is, where are they going? So that's a little discussion here, I guess, on some of the new stimulus package out. So good morning or good afternoon, Tony. Are you still with me?
Yes, I am.
Awesome. Okay. All right. So here we are. I'm Joe Lucey. For those of you that don't know me, I'm president and founder of Secure Retirement Financial. We specialize with comprehensive retirement planning with families in and nearing retirement. Most families hire us for three reasons. Number one, they want to maintain their lifestyle in retirement. They want to be able to spend in confidence throughout their retirement. I've never met anybody that works with us that wants to reduce their lifestyle in retirement. So our job is to make, number one, above all else, make sure that they can maintain their retirement income and enjoy retirement to its fullest, get even more out of retirement than they are right now. So that's the first thing. Number two, families oftentimes hire us because they are tax conscious. With $3 trillion or $4 trillion that we've put into stimulus here, with another $3 that it looks like the House is trying to pass. I don't know if that's going to go through, but to some extent, we're probably going to see some additional stimulus. I don't think it's no longer a question of whether or not we're going to see taxes going higher, but by how much. And our clients are hiring us to make sure that we can help them reduce taxation. The third thing is to help grow their wealth. If it doesn't mean compromising the income strategies that they want to live on in retirement, they want to maintain their lifestyle. But if we can, let's help them grow their wealth. A good partner of Secured Retirement Financial for many years now. Secure Retirement Financial, we as a firm have been around since 2005, but I go back to Minneapolis Portfolio Management Group back in my days with a company called Prudential Securities. It's a former Prubesh that I met a couple gentlemen called Phil and Harrison Grodnick. I actually have known Tony going back to 1999 or so as well. And they've been a tremendous partner of ours. Full disclosure here, I personally have 100% of my 401k invested in Minneapolis Portfolio Management Group. It's a portion of my portfolio for long-term wealth accumulation. And I think they do a fantastic job. So with that said, a lot of our clients have MPMG in their portfolios, and I thought it would make some sense. Hey, where have we gone here with the portfolio? Where are we at now? And then where do we see things going? So that's kind of the whole goal of today. We're going to hopefully keep this down to this 15 to 30 minutes that we've been doing these. I do want to make sure we spend a little bit of time at the end, though, with some Q&A. So maybe what we'll do is at a certain point, we'll just kind of let y'all know if questions start to go. We'll go ahead and shut down that portion. Then we can continue to go with I think that there's going to be some questions this week, maybe even more so than what we've had in the past. So here's our disclaimer. I'm not an attorney. I'm not a CPA, but we at Secure Retirement Financial, several of us are certified financial planners. We believe in a comprehensive planning approach, and we always have your best interest first as a fiduciary. So Tony, I think if you share your video, hopefully we don't take up the whole screen there. There he is. the man, the legend. This is Tony Shink, everybody, institutional director with Minneapolis Portfolio Management Group. And Tony, how about if I do this? I am going to go ahead and pass the baton to you for just a little bit. I might interject with a question or two as we go along, but I'm going to give up the mic here for the next few minutes over to Tony Shink here with Minneapolis Portfolio Management Group.
Oh, great, Joe. I really appreciate the introduction and the opportunity to, at least virtually, have a little lunchtime with you and the rest of Secured Retirement, as well as some of our investors. We're all these days trying to figure out how to maneuver in this new environment. And I'd like to spend a few moments describing who Minneapolis Portfolio Management Group is and how we invest our money, as well as kind of give you an idea of where we see things are going. Now, Minneapolis Portfolio Management Group has been around since 1995, and we became an independent entity back in 2004. We are 100% employee owned. We are a local firm based in Minneapolis and manage approximately $1 billion worth of assets for individuals, families, and institutions in downtown Minneapolis and throughout the country. This, of course, dollar amount was at the end of the year. With the markets bouncing the way that they have been, I do not have an accurate or current dollar value for you. We, as a money manager, work to create a fully diversified portfolio for our clients that is diversified among different market capitalizations, geographic locations, industries, and sectors. This way, when the markets are zigging, hopefully we are zagging, and that all of our positions are balancing each other out. Typically, when we invest in a company, we expect to hold onto it for 4 to 6 years. We are buying companies that take time for them to fix problems that made them cheap in the first place. And after around 4 to 6 years, when they become fairly valued, we want to sell them off to the eager and hopefully find the next opportunity for our clients. This type of invest and hold strategy typically is pretty low turnover. We do not trade a whole lot because we're waiting for these companies to become fairly valued, and then they slowly get ticked into long-term capital gains rates, which are more attractive than short-term. Our objective is to preserve our clients' capital and increase their purchasing power over time. And over the last 24 years, since our inception, 19 of them, we have been positive for our clients. Now, the way we go about doing this is trying to find great companies that are inefficiently priced. We look at probably around 4,000 different publicly traded companies at any given time. And what we're really attempting to do is try to find the best names that we can and whittle that down to around 20 to 30 names that typically get into our portfolio within about a year. Now, the way we do this is by things such as price to sales, price to book, and price to cash flow. Many of you may have heard of PE, or price to earnings. And these valuations, such as price to sales, price to book, and price to cash flow, are similar in the fact that we're trying to find great companies whose stock is inefficiently priced compared to themselves, their history, or their industry. Now, the first things we want to do is try to whittle these opportunities of 4,000 companies down to a couple handfuls if we can, and try to locate the businesses where a lot of the market risk has been lessened. Then what we want to do is take a closer look at what the business risks are. Do these companies have low to no debt? Are they generating positive cash flow? And are these businesses also run by individuals of integrity? Then what we want to do is really take a closer look at these companies and find out if these businesses have a catalyst. Are they not only producing those products and services for today, but what about tomorrow? And who's management? Are they incented appropriately? And the last thing we want to do is see if this business plan that management has in place makes sense. We are a bunch of state-educated individuals, And if there's a bunch of monkey business going on and off the balance sheet that we just can't figure out, we just say next. There's plenty of other companies out there, and we're looking for clean balance sheets with great management. And once we do that, hopefully we have found unique opportunities for our clients. And the last thing we want to do really is look for confirmation. And we do this by looking at insider trading volume studies, trying to see if there's other individuals out there that are seeing the same things that we are with great opportunities in some of these businesses. And after we do this analysis, about 20 to 30 names get through, and we'll hold those for the next 4 to 6 years. Now, if we take a step back and see what was going on just a few months ago when 2019 ended, it was a great year, and our value strategy was up over 21.5%. And the general markets, were fairly priced, if not overpriced, starting in 2020. In fact, Apple and Microsoft accounted for nearly half of the market's return last year. Now, what was interesting is that back in January, the coronavirus was still primarily contained in Wuhan, China, and surprisingly, the S&P 500 was flat in January. Then in February, the word pandemic started to pick up steam. That is when, starting in February 19th through March 23rd, the S&P 500 had lost nearly a third of its value. As it had dropped, it was followed by a delirious rally that recovered more than half of its losses. Now, this is probably the fastest drawdown that we have seen for the market correction. If we go back to the Great Depression, some of our world wars, the oil crises, where we have seen these type of losses before, or drawdowns in the market before, it usually takes a while for the markets to correct and for us to go up from there when we start getting into a bull market. Now, what's interesting is that the average market returns to normal in about 3 to 4 years. Now, if we take a look at some of the greatest market drawdowns in the history, be it the Great Depression or the financial crisis of 2008, which was our lowest performance, it has taken, the Dow back in 1965, it took that almost 16, 17 years for it to break even. And during the dot-coms, it took the S&P 500 back in 2000 about 13 years to break even, as well as the NASDAQ during the dot-com period. That took almost 14 years. Whereas in 2008, we were back even in just over 2 years. So we don't try to replicate the markets. What we try to do is anticipate where the greatest opportunities of inefficiently priced stock of businesses are and invest in those names. And then when we think they're fairly valued, we sell them off to the eager.
Tony, if I can just interject here for a second. So we have MPMG in 2008. It took about 24 months to break even from its losses. How long did it take in 2001 for you to recover those losses?
If you take a look back during the last decade, I'll say, we, from January 1st of 2000 through December 31st of 2009, I might not be answering your question correctly, but please tell me if I'm not. We actually had an annualized positive return during that period of 8.8%, while the S&P 500 annualized at a negative 1% a year for each of those 10 years, right after the dot-com implosion.
I think that kind of answers that. In fact, I know going back 2000, 2001, MPMG was their portfolios were positive. 2002, you've lost what the rest of the markets after the World Trade Centers, but then recovered substantially in 2002, 2003. Maybe a more important question than where we've been is where do you see things going from here? A lot of times we start comparing your portfolio performance to what the current S&P 500 is, or we start comparing to, we start to wonder maybe taking a more passive approach to investing, just to investing in the S&P 500 as an indice might be a lower cost, more efficient way and better way to get returns, or maybe whether or not we should be avoiding some of the different names and such. Where do you see things now? What are some of the areas that you guys are finding attractive, and kind of what are you looking for over the next 60 days as far as making sure that your portfolios are well positioned going forward?
Well, a couple of things. First of all, during this market drawdown in February and March, we took the opportunity to really capture some great iconic companies. We saw Starbucks drop from around $90 a share to upper 60s, multi-year low valuations on these companies. And we picked up Starbucks, which does about $26 billion a year in sales, at roughly $68 a share for our clients. Disney theme parks. Disney, which is a phenomenal business. When they mentioned in March that they were closing their theme parks down, we saw the stock drop from nearly $143 to under $100 a share. And we felt that in a matter of time, this company that not only has its Disney World and Disneyland and cruise lines, it also has a great media vault of companies like ABC, ESPN, National Geographic, and they also own about 67% of Hulu. So we felt that that was a great opportunity for our clients, and both of those names have started to do very well. If you take a step back, Joe, and take a look at how our portfolio is positioned going forward, we still like entertainment or more interactive entertainment and gaming. Companies like Sony and Nintendo that really held their own during this quarantine, or these house arrests, if you will, that we've been having over the last couple of months. We have invested in agriculture, companies such as Ingredion that make stabilizers and healthy preservatives for the food that we eat. Kroger has been doing very well for our portfolio. We continue to invest in technology, especially the 5G supply chain, which Barron's this week believes that the coronavirus has not materially altered the rollout of the 5G technology. So we have names like Cisco in the portfolio that build the infrastructure for routing the data and communications. Qualcomm is doing quite well for clients with their modems and the devices needing more RF or radio frequencies with low latency or very little lag time. We continue to believe that Corning Glass, or GLW, is going to do quite well with their fiber optics and touch screens. One of the other interesting things that we've been investing in is electric cars. With companies like Borg Warner, that is an advanced engineering firm, as well as OEC, or Orion Engineered Carbons, that manufactures carbon black that's used for reducing wear and tear on tires and makes the black color that we see on tires as well as our computers and monitors. One of the unique things that we've learned is that when you look at electric cars, Joe, is that these machines are significantly higher than our traditional combustible engine cars, and the wear and tear on tires is quite a bit faster. So we think that there's some unique opportunities with OEC. So is the worst behind us, I think, is what the question really is. And if we take a look of the data over the last couple of weeks, slightly implies that it is. If it turns out that it continues, that the numbers coming out over the next couple of weeks, I think we are in the free and clear. The market should be positive over the mid and long term. We continue really to look at trends. As an example, jobless claim reports really give us kind of a real-time look at the economy. And the claims have been consistently dropping from a high of 6 million beginning in April to a low of just under 3 million new jobless claims last week. That data, along with manufacturing numbers, are quite disappointing. However, the trend of recovery is what's important to us. And we're not investing for today, but we're rather looking for the opportunities of tomorrow and continue to look where the trends are pointing us. And when we look at some of the data coming out, we continue to see a positive trend, even though the raw numbers themselves are not looking so good or rosy.
Okay. Tony, you broke up a little bit there, but I think we got the gist of where we were heading there. Let me do this. As we've done here each and every week, we've opened up these calls afterwards. If you'd like to spend some time with one of the members on my team to discuss your current portfolio, if you'd like to discuss anything retirement related, whether it's about MPMG or just anything else, we always make sure that we've been making sure that our calendars are available. So I'm going to go ahead and put that offer out there now. If you would like to schedule a 15-minute phone call with somebody on my team, we'll make sure that we get back to you here. Just put you on the calendar. We'll make sure that we address anything you have. If you want some additional questions, or if you have any questions that you'd like and make sure that we schedule the time that you need with Tony. And as we go forward here over the next few minutes, if you have any personal phone or questions that are, maybe less personal, something more generic, and are comfortable asking those through the chat feature there, ask the questions. We'll spend some time going on that. So a couple things. I just offered the 15-minute phone conversation. If you'd like to take advantage of that, click on that. We'll make sure that we get you on the calendar. If you'd like to connect with Tony, we can set aside one-on-one phone calls with Tony. Or if you have something more generic, go ahead and ask the question here in the chat feature. Let me ask you another question here, Tony. With where we're at right here, I heard you say that you believe the markets are going to be getting better. What are those things that are keeping you up at night right now? What are some of the things that might concern you, whether it's regarding the current positions in the portfolio or maybe overall the overall direction of the stock market here?
Yeah, the overall positions in our portfolio, for the most part, I'm very comfortable with the names that we're holding and continue to invest in. More broadly, though, the things that I'm wondering about is, does this virus spike, or do we have a second wave come? And how will that affect the reopening of the economies? Are we going to have a potential close or lockdown again? When do the economies begin to normalize? That will help us start to determine how long we are in a slow growth mode. Are we going to have kind of a really quick return to a more normalized market? Was that going to be like a V shape or more of a U shape? What kind of a recovery are we going to have? And that really is determined by, how quickly we get back to a more normal economy and reopening. And the other question, it's a little more difficult to watch or to get a grasp of, is how much actual economic activity is really needed to justify the S&P 500 earnings expectations that analysts are projecting for next year. How much do these companies need to produce and sell to get to like $160, give or take, on the S&P 500 for 2021? Those are the things that really keep me up at night and make me ponder of what's going to happen and how we're going to get out of this. But when you look at our portfolio in the names that we're invested in, I'm pretty excited about it because historically, holding these type of companies, we've been able to annualize at about an 11.5% annualized return. which has historically, or at least since our inception, done about 1.5% a year better in performance than the general markets. So I'm confident we'll continue to be able to produce returns with great companies that are inefficiently priced.
You know, Tony, I am going to share your most recent first quarter market report. There was a question out there from Steve asking about how we can get a better introduction. Maybe that's a good way to do that. Somebody let me know if I guess I haven't gone with the offer and the files and everything else, so maybe I'm cluttering things up. I can turn off the offer or something if that makes sense. So somebody, I don't see that on my screen. If it's not coming across, let us know. But there should be an offer there to download a 2-page audited report that the Minneapolis Portfolio Management has done. This goes through the end of March, so you're going to see the ugly numbers in there from the March correction that bottomed out on the 23rd of March. So you can see that. We're also, I wanted to make sure we address here a question from Joel. Joel is asking us, Tony, with all the stimulus money out there, with all the, now they're throwing out money out of helicopters again. Quantitative easing is back in our discussions. We've had, $3 trillion of stimulus that's been raised. I even addressed it earlier. I believe that tax rates are going to have to go higher with all of this. But I think that the next question that a lot of times we hear is, what about the dollar? What about gold? Should we be buying precious metals? Maybe even loading up on some ammo or something too. But what are your thoughts here on gold and adding some gold into the portfolio?
It's a great question. Our portfolio, we actually have about 8% of our portfolio right now in cash, as we've raised money from names in our portfolio that we thought were fairly valued. And we have nearly 5% of the portfolio in Newmont Mining, or Newmont Gold Corp these days. That has done very well for our clients because we are concerned about seeing inflation. And having a little gold in a portfolio is a great way to hedge against that inflation. And the concerns that you raise about increasing taxes and just inflation in general with asset appreciation is something that we're watching very closely, and continue to believe that our gold position is going to do quite well. One of the other things, as an aside, is that last time that gold did very well during the financial crisis of 2008, you saw the inputs rising very quickly, or the cost of those inputs rising very quickly. Whereas this time around, we've had almost no inflation on the inputs necessary to mine gold. So we continue to believe that the miners should do even better than they performed back during the financial crisis.
We're getting some questions. I actually had one come across in a text here a second ago. If you have questions, feel free to use the chat feature there, and we'll make sure that we address those. If it's something a little bit more personal, there should be an offer at the bottom of the screen there. You can schedule 15 minutes, and our team here, we can try to address it. If it's more portfolio structure, if it's actual portfolio positions, we'll make sure we bring on Tony and we can answer those individual ones. One question though and this isn't the only time I've got that, so that's why I wanted to bring it up again, Tony. A lot of concern here about maybe some exposure you have to the airlines right now. You had some Delta, a little bit of United Airlines. That position, maybe you can talk a little bit about that. In fact, Expedia was another position that that was in this leisure area and the travel area that with everybody getting sheltered in place. It's one of those things that when we look at our portfolios and we see this Boeing and Boeing is a position that, for the most part, I think most of us are down on. What gives? What are your thoughts on Boeing and Expedia and even some of those airline stocks that we had in the portfolio?
Those are very tough questions, but important questions to have. Expedia was a very unique experience for us. Now, Expedia is an online company that you can book airline travel. You can book cruises as well as hotels. And when we picked it up, we had picked it up just right. I believe about a week after we first started investing in Expedia, the stock was up very nicely. And then the coronavirus pandemic started to pick up speed. And our concern with Expedia is that we would not be able to in any way figure out how much that they were going to earn. They could earn $2.50 a share. They could earn $11 a share within the next year. And because of the amount of uncertainty and how quickly things were changing, we felt that it was best to exit Expedia, which turned out to be a smart move for our clients. We didn't make any money on the name, but we really didn't lose anything for our clients either when we exited that name. Now, Delta Airline and United is a little different story. We were obviously early on buying Delta. The reason why we chose this name is that they are financially were the strongest position of the major airline carriers, and our thinking was that as we go through this experience, that Delta will likely come out as one of the winners on the other side and have the opportunity to buy some of their smaller competitors and increase their geographic footprint globally. Now, we had purchased it at around like $40 a share. And then when the stock had dropped almost in half, we made the decision to capture that tax loss because there's something of value with the tax loss, and figured we'd buy United Airline as a placeholder for the next month for our taxable accounts, and kept Delta in our tax deferred accounts. As the coronavirus pandemic continued to pick up steam, our concern was that this is going to be a very, very long-term painful experience for the airlines, and the best thing to do is just to lick our wounds, say we made a mistake, and put that money on the sideline for new opportunities. Now, what comes hand in hand with Delta is Boeing. And why did we decide to hold on to Boeing, whereas we just sold out of our commercial airline carriers? And that's because Boeing is our country's largest exporter. And what we forget with all the bad headline news that they've had over the last year with their 737 MAX planes is that 40% of the revenues actually come from from defense. So this company has a pretty diversified revenue stream. And when you look at the bigger picture of Boeing, they interact with roughly 17,000 businesses throughout our country. And those businesses, along with Boeing, employ nearly 2 million people. So our thinking is that the United States federal government and the states that have heavy buildings or heavy use of Boeing in those states are going to work with that company to make sure that it not only survives, but it comes out ahead once we get through all of these, all these headaches that we're experiencing right now. And we continue to believe that Boeing will be fine within the next 2 to 3 years.
Tony, let me, before I go there, we're going to go ahead and shut this down here in about the next 5 or 6 minutes. We'll probably have time to answer 1, 2 more questions, 3 more questions. So if you have a question, feel free to click the chat there or just type in your question. We'll make sure we address it. If you'd like some 15-minute time to address something more personal or what have you, maybe overall financial planning strategy, ask. You should still be able to click a link at the bottom of the screen there that'll allow you to get on our calendars for 15 minutes. If it's more personal, we want to bring in Tony, we can always do that. He's made himself available for all of our clients. But Tony, kind of the next question here that I think we wanted to spend some time on here is really coming from both Bob and Paul. I'm going to combine the two. It says, number one, what other stocks are attractive to MPMD in this current market environment? So what kind of stocks do you guys have on your radar? And then Paul Haynes, very similar question maybe. or maybe there are two questions. I'll let you address it the way you want to. Says, seems like social distancing is going to impact other industries for quite some time, but it's also going to allow us some other opportunities that maybe, in fact, I saw something the other day. Zoom is now higher valuation than all of the airlines combined. So Zoom, which is, the video conferencing that many of us had to be, me in my office had to get used to real quick here. It was something I was familiar with, but not something I was using on a daily basis. And now we have, are there opportunities like Zoom or maybe something else? And maybe overall, just kind of up a little bit higher. What are the stocks you guys are finding attractive? What are some sectors you guys are looking at, and what have you? And we'll go ahead and let you answer that.
Oh, sure. Well, first of all, there's definitely a lot of changes that are going on. Zoom, which is really the name of choice these days when it comes to video conferencing. I believe last time I looked at it was trading at about 50 times sales. Joe, I think you'd be ecstatic if somebody came to you and offered you 50 times sales for your business.
Sold.
Yes. It's a great for somebody willing to take that offer. However, we're trying to create investments for our clients that are going to last quite a while. So we're looking for what's working for tomorrow, not necessarily what's working for today. And Zoom is just way too pricey for us. However, Cisco, which I mentioned before, they own WebEx, which has a significant footprint when it comes to video conferencing in the institutional world. When you look at the challenges that we're going to have and are starting to see in our agriculture infrastructure of getting food to the grocery stores and onto our own tables, we own a company that was a spinoff from Ingersoll Rand, and that stock symbol is TT. And
Train.
TT is, which is one of the owners of Thermo King. Thank you for Train Technologies. Thermo King owns and creates refrigerated transportation. Now, what we may not realize is that trucking accounts for nearly 3/4 of our nation's freight from point A to point B. So we continue to believe that Thermo King is going to do very well, or Train's going to do quite well in this environment. We are really interested in a small cap company called Coherent. Stock symbol is COHR. Now, Coherent is a laser company. So if you've ever had eye surgery, it's a good chance that you were worked on by a Coherent laser. That company also makes lasers that are made for our OLED screens that are seen on our TVs, our computer monitors, and quite a few of our cell phones and cars. So we think that Coherent is a company that's going to do quite well going forward as we continue to see some of these changes, such as social distancing or more video conferencing going on like we're doing today.
Does anybody else have any other questions? And then I got one final here, and then we'll go ahead and wrap things up. But if anybody else has another question, let us know now. Again, if you'd like to find some time on the calendar, there should be that link there to do that. Just click that. We'll schedule 15 minutes either one of my advisors can address with you individually, or if it's more specific to the portfolio, we'll find some time. We'll get on Tony's calendar. We can ask those personal questions, because we know that a lot of you have put your faith and trust into Tony and what they've been doing there at Minneapolis Portfolio Management Group, and maybe you have some more specific questions. I'm not seeing anything come across, so I'm going to ask the last question here, and then we'll go ahead and wrap things up, Tony. I had a situation the other day, and the question was more with somebody that may not already be invested with Minneapolis Portfolio Management Group, or maybe they have, but they've now had a let's call it a windfall. Maybe it was some kind of triggering the sale of some real estate. Maybe they are now in the process of rolling a 401k over. So they have a lump sum of money. What are those things before they should invest that into Minneapolis Portfolio Management Group? What are maybe those couple things that they should be factoring in before deciding whether or not they should put it all in at once or piece it over time, or how that all fits in?
Well, my first thought is always, do you have enough cash on hand to weather sleepless nights? If you got, upwards of a year's worth of cash on hand, 6 months minimum, then the next thing to do is really to start to look at how is this money going to be protected and grow over the next market cycles and generation. Because if you got some money on the sidelines, you're able to sleep at night knowing that the money that's invested in a diversified portfolio that Joe is very good at creating those strategies for is allowed to work and do what it's supposed to do. When we take a look at our portfolio of 20 to 30 equities at any given time, new accounts typically have a higher cash position because some of the names in our portfolio are fairly valued, or we're waiting for a report to come out. So instead of putting all of the money to work, especially in a name that we might be getting ready to sell, we'd rather wait for the next opportunity. However, over about a year to a year and a quarter, that new account, if you will, invested with us will start being invested or look very closely to our composite or our legacy accounts that have been with us for quite a few years. Does that answer your question, Joe?
Well, I think that to try to bring that down, you take each of the portfolios as you receive the funds for the account and you actually manage them individually. It is a little bit different strategy than what many portfolio managers that we have used in the past do. A lot of times, if you go buy a mutual fund, you're going to be completely diversified across the individual accounts that mutual fund owns. If you buy a third separate managed accounts, a lot of times they'll kind of go through and buy the model. If they own 2% of XYZ, they're going to buy 2%. Where the MPMG team, the analysts, the CFAs and such that are working on our portfolios with Minneapolis Portfolio Management Group, what I heard you say is that they will kind of ease into it a little bit on your own. So you're not necessarily going to be at risk of putting 100% in the market overnight. It does get kind of blended in a little bit. You might not buy every position that's in the account for somebody that gives you new funds, which is actually something that we've seen here at Secure Retirement Financial, and something that we really think creates a lot of value that Minneapolis Portfolio Management brings to us and our clients. So that is something that's definitely a differentiating factor, which I'm glad you brought up. Keep in mind, he talked about a little cash on the sidelines. We believe that having that mailbox income, money that hits the checkbook each and every month, if we have money that doesn't have to be taken out of an account, whether the markets go down over the next 3 to 4 months, longer term picture over the next year to 3 years to 5 years and beyond is more important. So making sure we have money set aside so we aren't forced to take money out of an account that just got clobbered is definitely something that we bring into every one of the portfolios as we make recommendations, whether we use MPMG or any of the other managers. With that said, Tony, I wanted to spend just a second. I wanted to thank you for taking some time here today. This call went a little bit longer than we have the last few times, but I think it was a good call, and we're going to have it recorded. So if you would like to see get the recording of this, put in the text message here you'd like a recording of this. We'll make sure we get it available. Probably be available because of the timing of everything and things. We're probably only going to be able to make it available for like the next 24 hours. So that's a compliance thing that the industry has. So we'll make the video available. If you want to make sure you get that, just put it in the chat. We'll come back to it. If not, schedule that 15 minutes we talked about. Actually, I'm supposed to show this disclaimer here. Here's a disclaimer that Tony's compliance group had us put together. You can read through that. And again, if you want to reach out to us directly, the office number is 952-460-3260. Last thing before I go, we've been doing these every Monday. I've been doing them every Monday since March 23rd, which happened to be the market bottom, and things have gotten better. Next Monday, we've got Memorial Day weekend. I'm going to make sure that we have everybody that works for us at our team here, that they're going to be able to spend some time social distancing with their family. Some of our clients are going up north and such, which is nice to be able to get away and do some of that right now. But we're going to be closed on Monday. So the next one of these is not going to be next Monday, the 25th. We'll be doing it, what is that, June 1st already. So on June 1st will be our next huddle with Joe Lucey. And anyways, I hope this was of value. If you have anything to reach out, feel free to reach out to us directly, and we'll make sure we address any of that. Tony, thank you again.
Well, thank you, Joe.
Appreciate
the opportunity.
Have a great rest of your week, everybody. Da, da, da.